You decide to start investing. Open YouTube and type "how to make money." Instantly, you're hit with three aggressively loud worlds. One video tells you stocks are the safest, most mathematically sound way to build wealth. The next insists crypto is the inevitable future of money. And then a third pops up, claiming Forex traders pull thousands of dollars a day right from their laptops. Confronted with all these promises, most beginners don't just pick a lane. They try to learn stocks, crypto, and Forex all at the exact same time. Juggling different technical charts, widely varying risk profiles, and conflicting strategies leads to immediate confusion, serious burnout, and the rapid loss of whatever cash you started with. Treating these three different arenas as parallel paths spreads your attention too thin to master the actual mechanics of any of them. Most new investors start out by asking the same flawed question: which of these markets will make me the most money the fastest? A much more pragmatic question is to ask, which market serves as the best classroom to teach me the financial habits I actually need? This split-screen chart illustrates the difference in those classrooms. On the left, you have a steady, historically proven upward trajectory averaging about 10% growth. On the right, you see a highly erratic terrain defined by massive vertical spikes and devastating rapid drops. Investing demands the development of specific psychological skills, such as risk management and strict emotional control. Your optimal starting point is the market that forgives your early, inevitable mistakes, while steadily forcing you to develop the iron discipline you will need to survive higher volatility arenas later on. This comparison matrix breaks down how these systems operate, starting with stocks. Buying a stock means purchasing fractional ownership in a real, productive business like Apple or Amazon. Historically, buying the 500 largest companies in the US through the S&P 500 has yielded an average annual return of roughly 10% over the long term, powered by the math of compounding. That reliability requires you to sacrifice the dopamine hit of overnight riches and exercise a massive amount of patience. This slower, boring environment trains you to evaluate business models, earnings reports, and long-term value rather than chasing internet hype. By prioritizing the mathematical reality of compounding over the hope of quick wealth, the stock market serves as the most effective foundational training ground. Now, look at crypto. Instead of owning part of a business generating revenue, you are purchasing decentralized digital assets, where the value is largely driven by market sentiment and technological speculation. The appeal is obvious. Crypto can produce extraordinary, asymmetric gains. Bitcoin, for example, went from around $1 in 2011 to trading above $60,000 at various points. But that upside carries a penalty: extreme volatility. Crypto routinely experiences market crashes of 70% or more. For an unseasoned investor without established emotional discipline, these massive drops are a psychological trap. Novices almost inevitably panic and sell right at the bottom. Crypto acts as an accelerant. It amplifies both financial gains and psychological flaws, making it a dangerous place if you haven't yet learned how to control your emotions. Finally, we have Forex. This is the trading of global fiat currencies, like the dollar against the yen. It's a $7 trillion daily market that relies on profiting from microscopic shifts in exchange rates. Because those daily movements are so small, brokers offer leverage. This allows a trader to control $10,000 worth of currency using only $500 of their actual capital. While leverage magnifies potential gains, it violently magnifies losses. If a trade moves against you by even a fraction of a percent, your entire account can be instantly wiped out. This exposure is mathematically punishing. Data from multiple brokers shows that between 70 and 80% of retail Forex traders lose money. Forex is a tactical, fast-moving trading arena that punishes minor errors with total financial ruin. It is not an entry-level investment. Think about the distinct risk profiles of these three markets like learning how to drive. Learning long-term stock investing is like driving the reliable sedan on the left. You learn the basic rules of the road, build your confidence, and safely navigate a straight, predictable highway. Jumping straight into leveraged Forex or highly volatile crypto is like putting a beginner behind the wheel of the Formula One car on the right. Technically, you can step on the gas, but your chances of crashing are almost guaranteed. The habits learned in the sedan, pacing, risk management, and emotional control, are the mandatory prerequisites for surviving the faster, more dangerous machines. Mastering the slower mechanics of traditional investing equips you with the exact risk management skills you need to eventually succeed in high-risk markets. Approaching these markets effectively is a matter of sequencing rather than a one-time selection. You start with Phase 1, mastering the stock market to build your core risk management and psychology skills. If you are completely new to this, mute the online noise. Dedicate your focus to understanding long-term index funds, building baseline capital, and letting compounding work for you. If you've already tried day trading and lost money chasing quick profits, stop trading immediately. Use the stock market to hit reset, cool off your emotions, and rebuild your financial discipline. With fundamentals ingrained, move to Phase 2, safely exploring crypto as a small portfolio allocation. Finally, Phase 3 sits at the top. Approach Forex only with severe discipline, advanced market understanding, and surplus capital you can afford to lose. True wealth relies on the aggressive mastery of the boring fundamentals that protect you from ruin.